This Reddit user asks, given an infinite time horizon, why not invest in 100% equities? Further saying, bonds seem foolish unless you are planning to withdraw funds within the next 5 to 10 years. Is there any other reason for bond allocation? Do bonds provide that much utility when rebalancing during a downturn? I don't find that argument compelling when you have no intention of selling during a correction. When the market crashes, just buy more. What am I missing? Let's unpack this, because the concept of having zero allocation to bonds has really gained a lot of attention over the last couple years, particularly as investors have realized that bonds don't necessarily provide the diversification value all the time, and they certainly did not over the last 3 years here. Looking at this chart, I've got the S&P 500 represented by Vanguard's S&P 500 mutual fund on here, along with Vanguard's total bond market fund. And over the last 3 years, we can see the total bond market fund is down 7.09%, while the S&P 500 is up 34.26%. Particularly the last 2 to 3 years, 2022 and 23, have been among the worst years in bond market history. And if we look at 2022, we can see there was no diversification value really for bonds. Bonds were down, as were equities, and well, going forward, equities rebounded and have climbed up. Bonds have not, have not done that in this rising to high interest rate environment that we have been in. So yeah, this has a lot of investors wondering, hey, why shouldn't I just be 100% equity? Now, first things first. Number one, there's no such thing as an infinite time horizon, and I think to take this from a more practical perspective here, let's just say a time horizon of 30 to 40 years, why not invest in 100% equities? Well, first things first, drawdowns can be incredibly painful. And most investors really don't know what their drawdown tolerance is because they haven't lived through really any drawdowns at all. And, I will say that in my experience, most kind of novice investors or people just getting into investing, they look at it and they say 10 to 20% drawdown, I couldn't live with, right? But then you live through one and it's not really that bad. And then you kind of start wanting to take on more risk. And I personally do fall into that category. I've been through the 10 and 20% drawdowns, went through COVID, but I have not been through a 50% drawdown like 08 or 09. At that time, I was, getting started investing. I was 18, 19 years old in 08 and 09, and I was kind of playing in some stocks, but I did not have a big allocation to equities, and I was not relying on it for A, retirement, B, my own personal lifestyle as I am now. But that said, I do remember seeing my professors, particularly a couple finance professors that were heavily invested, just having very bad days in 08 and 09 particularly. And, looking back, they were having a very painful time. And that's because sitting through those big drawdowns like the Great Recession, and let me just pull it up on the chart here. Let's just go back to, just say 2007, pick a date there. And seeing the drawdown here, and it looks minuscule in the grand scheme of things, but from peak to trough, the S&P 500 was down 50 to 55%, right? It's a painful drawdown. I don't know what it's like to experience that. And it's easy to say, to yourself that I won't sell during those periods. But when all of the news is just blood in the streets per se, and, talking about economic crises, and you don't know if the market's going to go from 50% down to, down 90%, right? And where you will have had a more substantial loss of capital. I personally don't think I could sit through that. I wouldn't want to sit through that. All right, so that's kind of where bonds will still hold up some value if there is this type of scenario. And not only with the sharp drawdowns, and, the reality that when the market crashes, the thought that you have no intention of selling during a market correction, right? I think that kind of gets thrown aside. But anyways, if you look at some periods, there are periods where the equity markets have just gone sideways. And I'm going to show you here what's called the lost decade from end of 99 through the end of 09, the decade of the 2000s, where equity markets really went nowhere, right? And now we can see that the Vanguard Total Bond Market Index Fund is up 80%, while the S&P 500 is down 10%. So bonds provided some pretty good diversification value here. And what's important to consider is that just because in the last 3 years, what's in our most recent rearview mirror happened, and it did show that there's not always diversification value, speaking over a broad period of time, there is diversification value there. Okay, but still, if your time horizon is 30 to 40 years, maybe you don't care so much about that diversification value, but still, it's very difficult to constrain our psyche and continue to hold during those positions. And number two, you might also need the money during drawdowns, right? In 08 and 09, this is when people are losing jobs and losing their source of income. Other leveraged investments are collapsing and going to zero. And for example, that may be in real estate. That applicable to myself. I buy businesses using debt. That is risky, can go to zero. I like to think that I know what I'm doing, and I'm, buying good enough businesses that they're going to be resilient. But, when you're dealing with debt, things can go to zero. And then subsequently, you have to draw out of your portfolio. Well, when you're doing that, you're going to draw out of the portfolio at the worst possible time, which is during a decline, during a major correction. That's the worst possible time because you're not going to get the rebound on that capital. So the reality is that life happens. And while it's easy to say this stuff, you do have to consider there may be substantial corrections or substantial periods where your equity portfolio goes nowhere. Now, let's talk about what alternatives there would be to a broad market equity portfolio that's market cap weighted like the S&P 500 that may be more robust. Okay, because in this video so far, all we've done is look at the market cap weighted S&P 500, and broadly speaking, global equities would follow the same trajectory, right? What could you invest in that's not quite broad market cap weighted indexes that would provide you diversification that is likely to be more robust during these time periods, right? Where equities are going through major corrections or sideways markets. Well, for that, you could do what is commonly referred to as a defensive allocation, and that is investing in sectors of the market that are likely to remain resilient during economic downturns or global market calamities. And those would be commonly, a defensive portfolio allocation is commonly consumer staples, healthcare, and utilities. Right? No matter how bad the economy is, we still need power, we still need water, we still need our communications infrastructure, all of that stuff. Those are utilities. Everybody's still paying for it. We still need healthcare, and healthcare is largely government subsidized. And, well, we're still going to need our staples. We still got to buy deodorant. We still got to buy toothpaste, those types of things, right? So those sectors aren't known for high growth, but they're generally economically resilient. And I've put them on a chart here so we can take a look at them. And by the way, I'm using Vanguard's sector ETFs for the US. I believe it is BlackRock iShares. They have funds for global consumer staples, global healthcare, global utilities as well, which may be considerable for those of you that don't want 100% exposure to the United States markets. That's a whole nother topic for another video, but if we look at the performance over the last 10 years here, Portfolio 1 in the middle, this is the portfolio that is equal weighted of the three sectors. And then we can see up here, this is the S&P 500. It's ultimately returned the most. And then at the bottom is bonds, which over the last 10 years has not returned very much. If we look at the total return value, S&P 500, $32,000. This is assuming a starting value of $10,000. Portfolio 1, which we're going to call our defensive portfolio of equities, $23,397. Portfolio 2, bonds, $11,373. So huge difference here and major outperformance over bonds. And we can see that the growth trajectory is kind of stable and up. It doesn't have as major declines, and it's not as susceptible to bubbles. It just kind of hums along. And if we look at the actual performance summary. Let's see here if it gives us a annualized return. S&P 500 returned 12.81% versus our defensive portfolio at 9.03%. So you trade off a little bit of the upside for not having the kind of bubblish and volatility of a market cap weighted portfolio. We can see volatility measured by standard deviation right here, 11.92% for that defensive portfolio versus 15.37% for the S&P 500. So yeah, this is one consideration and one portfolio strategy that you might want to implement if you don't want to be 100% equities, 0% bonds, or I shouldn't have said that. This might be a strategy you could implement if you don't want to be entirely 0% bonds, 100% market cap weighted, having a portion of your equity allocation in a defensive strategy like this. And mind you, there are other strategies out there based on fundamentals and, primarily fundamental things. Free cash flow, that's a fundamental. That's where I was going with it. You could do debt to equity ratio, free cash flow. There are various investment vehicles out there, ETFs, that get exposure to those things on a fundamental basis to get you away from pure market cap weighting that is likely to be more robust in scenarios where there is an economic downturn. And that may be an option. And personally, that is an option for me. It's something I invest in to get away from from purely market cap weighted equities and 0% bonds. So yeah, if you, all in here on this, if you are considering going to 100% equities, there's not necessarily, a bad reason. You just have to consider your risk tolerance. And I will say that that is probably lower than what most people, feel is acceptable for them, or what most people will say and think is acceptable for them. But that said, there are alternative strategies out there like the defensive portfolio. And one final thing before I wind down here, if we were to see the defensive portfolio in the lost decade of the 2000s, it probably would have been positive. And let's just actually put one of these on here. I don't know when these funds started. Yeah, they didn't start long enough for us to get an easy back test, but I'd kind of looked at this through other data that, a few years ago that was not so easy to access, and looked at, the defensive portfolio, and it actually did quite well through here. I think it was up maybe 30 to 35%, right? So you would have had a nice outperformance over the S&P 500, but not nearly as good as bonds. Anyways, guys, on that note, I hope you found this video helpful and insightful. If you have any questions or thoughts, drop them in the comments below. And if you found this video helpful or insightful, you know the drill. Smash that like button to help me out in the YouTube algorithm. I am calling it a wrap and signing off.